Firstly, we have Dinesh Khara with us, the Managing Director from State Bank of India. So straight away to him, Mr. Khara, what did you make of the rescheduling announcements or restructuring announcements? Mr. K.V. Kamath will be drawing up the principles.
I think it's a very welcome step taken by Reserve Bank of India. NBFCs as well as banks have been saying for some time that probably moratorium and block moratorium is not something which is required. It would be some kind of a restructuring depending upon case-to-case basis would be the best of the situation, which would really help in mitigating the hardships which are being faced by some of the sectors in the economy. I think to that extent it's a very welcome suggestion, and apart from that, other aspect which has been emphasized is increasing the LTV in case of gold loan also, because gold is always considered to be the asset which is available in many households in the country, and perhaps it will really help in addressing the financial stress faced by many, and if they can borrow more against the gold as an asset, I'm sure it will also lubricate the economy and also will help the growth concerns of the economy. And further, I think the other aspect which has been highlighted is relating to the startups being accorded the status of the priority sector. I think we had seen a lot of startups coming up in the economy, which were actually facing a lot of stress in the last 3-4 months. So with this special status of the priority sector, it will again be a positive for the economy at this point of time.
Yes, startups was a welcome inclusion, and also they're going to tweak some weights with loans, priority sector loans given to districts which are underbanked, getting a higher weightage, and loans given in districts which are well banked getting a lower weight. And then of course solar power also and biogas likely to get greater weightage within the priority sector. Mr. Khara, just 1 minute, I'm coming back to you. Anant, if you could, did you parse the sentence on restructuring? I mean, I just got an aside that Mr. K.V. Kamath will set up the principles, and I thought he also set sectors. Did you get a sense that the principles laid out by the K.V. Kamath committee will be sectoral?
I think it's a great start, Lata. Look, the fact is there is so much of distress around that a one-time restructuring is required. I think everybody will agree. But as Mr. Vishwanathan said in your channel, it's very important it's done in a credible manner, and it's not seen as something which will impinge upon financial stability later on. It shouldn't become a kick the can down the road. So the principles he mentioned, safeguards, entry norms, boundary conditions, independent validation, post restructuring monitoring, I think all of these are excellent principles to try and ensure there is credibility around the process, and it's a rule-based system rather than an ad hoc system. Again, getting somebody like Mr. K.V. Kamath, who's been there, done that, understands the business, I think will make the way for a very, very practical solution which still maintains that credibility. All in all, frankly, I couldn't have expected and asked for more. I think Mr. Governor Das has done a good job in this particular case.
1 minute, Anant, Ritu has got that paragraph of the conditions which Mr. Kamath will use.
Yes, it has been decided to provide a window under the 7th June circular to enable lenders to implement a resolution plan in respect of eligible corporate exposures without change in ownership 1, as well as personal loans. So those are also included, while classifying such exposures as standard assets subject to conditions, and in the light of the past experience with regard to the use of regulatory forbearance, necessary safeguards have been incorporated, including prudent entry norms, clearly defined boundary conditions, specific binding covenants, independent validation, and strict post-implementation performance monitoring. The underlying theme of this resolution window is preservation of the soundness of the banking sector. The K.V. Kamath Committee will make recommendations to RBI on the required financial parameters along with sector-specific benchmark ranges for parameters to be factored into the resolution plan, and they will also undertake a process validation of resolution plans within the specified threshold. So that is as far as that is the only detail RBI has given.
I think maybe you want to give this this paragraph to the producers, and we should be running this as much as we can, because it's a fairly detailed paragraph. So there will be entry norms, and I think one of the entry norms, he said they have to be standard as on March 1st, if I'm not mistaken. Yes, standard on March 1st. That is the entry norm to be eligible. And then the boundaries, and he also said validation. Mr. Khara, if validation, would it mean that the restructured plan should get a rating agency approval, or would it be the KV Kamath committee giving a validation? How are you reading this? Because rating agency in the past has not been a very happy experience.
No, I think as I read it, perhaps, more so, it would be applicable for some of the SMEs too, who may not be subject to rating. So there could be certain boundary conditions which could be perhaps prescribed by the committee. And
boundary conditions, sir. What is boundary conditions?
Boundary conditions could be in terms of, their financial health, in terms of the sustainability of the project, or maybe the venture which they are doing. And also, for instance, if at all during the COVID situation, if at all they have witnessed some kind of a stress on their cash flows, so that could be the other boundary condition which would be required to be satisfied. So
a boundary condition that the loan can only be extended by 2 years or 3 years. Is that what is meant by boundary?
No, I think, as I understand, is because they have expected the account to be standard as on March of the year 2020. So which means that they are essentially trying to capture all such accounts which have witnessed the whole lot of cash flow disruptions during the COVID, and the intention is to really give them a support at this point of time. So I think boundary condition would be essentially in terms of monitoring that how they are really start performing, which would be during the COVID or post-COVID situation. So that would be subject to very closer monitoring. That is something which I can visualize. And apart from that, the intentions are something which are required to be evaluated in terms of the promoters' intentions to really support the venture. That would be the other thing which would be required to be seen. So essentially, I would say that it would be the promoters' commitment, and also how far the cash flow destructions can be reflected.
Actually, let me read out more details on this recast plan. Some of the conditions the Reserve Bank of India has now laid out, and they're reading them out. One is that the borrower, and this is for non-personal loans, will have to be classified as standard and not in default for more than 30 days as on the 1st of March to be eligible under the scheme. All other accounts will be considered for resolution under the June 7 circular itself. The resolution plan can be invoked any time until 31st December 2020, that is the end of this year, and it will have to be implemented within 180 days of the date of invocation. So similar to the timelines that we see under the June 7 circular and the IBC. In addition, and this is important, lenders will have to keep aside 10% provisioning on the post-resolution debt. Generally, if you recast, 15% is a provision you have to make.
First, the desk needs to flash this, that 10% provisioning has to be kept on all the loans recast, and the entire restructuring should be done in 180 days. And they have to be standard as not overdue for 30 days before not more than 30 days as of the 1st of March. But for non-personal loans, I think the resolution timeline is half. It's 90 days. Okay. Mr. Khara, you want to comment on that? And Ritu, I think those should be flashed.
Yeah, I think as I sense it, very important part which has been indicated is that the banks are required to keep a provision of 10%. So I think in terms of spirit, it is what was there in the earlier circular also, that banks are required to provide for whenever any such kind of a reconstruction plan is being approved. So it is ensured that the bank's balance sheets are not weakening in the process, and they are keeping enough cover in their balance sheet. So it is not going to be a reckless restructuring which was witnessed sometime back in 2006 to 2008. So those kind of incidents will not be repeated, and the interest of the borrower as well as of the bank stays protected through this kind of a mechanism. This is how I would really read this.
Okay. There is also an e-Kuber system to manage CRR, so that also is something that the central bank has mentioned. Mr. Khara, if you can just hold on for a minute, sir, we will put out this, what they're clearly saying is only those borrower accounts eligible for resolution under this framework which were classified as standard but not in default for more than 30 days with any institution as on March 1st. How would you define not in default? It is one day default, or is it 1 month default, or is it NPA? Okay, not in default for 30 days, all right.
Not in default for 30 days is very clearly stated.
So if your loan was due on February 1st, you would still be eligible?
Yes, that's right.
Okay, so all loans that were standard and as on March 1st, and even if they are overdue by 30 days, that is, they should have paid on Feb 1st, all those loans will become applicable. I think that gives a fairly broad swathe to the banks, but there is 10% provisioning coming. Will that, okay, we've got Neeraj Gambhir also with us. Neeraj Gambhir, will this 10% provisioning make people a little wary or choosy in whom they will give restructuring?
So clearly, I think, Lata, in all of these restructuring thought processes, I think the learning of the past has been that if you just restructure and you don't recognize the fact that there has been some kind of weakening in the credit quality, so I think that kind of gives an adverse incentive to the system. So the requirement to maintain 10% provisioning on the assets that you restructure, I think it's two endpoints. One is basically the fact that the banks are keeping aside some capital for a potential down the line, because not all restructuring may succeed. So there is some sort of capital cushion and the penal cushion that is available for the banks to take care of it. And second is that the banks are also mindful of the fact that restructuring on a larger scale will have an impact on their capital position. And in this environment, they have to also conserve capital. So I think there is, I would think that there is a dual objective behind this requirement. We saw this in the case of moratorium as well. I think that has been sort of carried forward from moratorium to restructuring. It is expected that if there is a restructuring, there is going to be some kind of provisioning requirement.
Okay. Neeraj, do stay on. We also have Sunil Mehta, the CEO of the Indian Banks Association, with us. Well, at the moment, I must also inform you that the Nifty Bank is up and away, but as is the Sensex and the Nifty, because it's not just banks who are going to benefit. It is in fact those who are borrowing from banks who will benefit because of this because of this provision. Mr. Sunil Mehta, do you think banks will be willing to give this provisioning somewhat liberally, and will it come with a higher cost because you have to provide 10% and therefore bankers will price that in?
Lata, I think this is a very welcome announcement, because the past experience of the restructuring where it was rampantly used, and now at least the bankers will definitely use it in only genuine cases that they think that in post restructuring it will really create a viability of the unit. And I really treat it as a very balancing move in which a window for restructuring has been provided even with the existing promoters. So that is what we have demanded from the IBA side also, that all those cases in the June 7 circular above 1,500 crore, we should be permitted to restructure with the existing promoter. So section 29A will not apply there. So that is one relief the RBI has given. The another advantage is that 10% of the provisioning. So bankers will definitely, and the borrower will definitely be interested in taking restructuring where they really feel that they need a relief from the present liquidity issues. And for that, if there is a 10% provisioning, that creates the strength of the balance sheet of the bank also. So the stability of the banking system is also ensured, as well as the window is also made available to the borrower, so that they can create and maintain their asset as a standard during this difficult COVID point.
Got it.
The most important point is,
yes, sir.
At the entry point, they have already put a restriction that it has to be just like the emergency line of credit.
Yes.
They have also defined that it should not be more than 60 days.
Yes. Yes.
So
yeah, it has to be standard on March 1st and it should not be overdue more than 30 days. Yeah, we just read out that point, sir. Thanks a lot for that. Do stay on, sir. Anand, you wanted to come in on the structuring of the restructuring?
Just a couple of quick points. One small point, Lata. If it is, it should not be in default for more than 30 days as of 1st of March. Does that indicate that SMA1 and SMA2 loans will not be eligible for restructuring if they were SMA1 or SMA2 as of the 1st of March? I think that's one question which comes up. I think in the specific...
SMA0, isn't it? I'll just have that answered. Hold on for a minute. Mr. Khara, that means only SMA0 will be eligible, right?
Yeah, as it is very clearly articulated that it should not be overdue as on
March
1st of February.
Yeah.
March 1st, they are saying that 30 days is accepted. So as on 1st of February, it should not be overdue. So that is very clearly mentioned.
Okay.
That's entry restriction for this purpose.
Okay. Anand, some other point you had to make?
Yeah, second point, I think for MSME specifically, I heard the governor say that it will be for all standard assets as of 1st of March. So I'm presuming that this stipulation will not apply for MSME, which is a good relief. Third, larger point I want to make, look, I'm presuming therefore that the moratorium will not be extended beyond August, since they clearly want to come out with a allowance for restructuring. Now, what that means is that in terms of disclosure, the disclosure of bank accounts will probably improve dramatically in the next quarter results. One issue we had as of the June results is because of this moratorium and lack of uniformity on disclosures, one wasn't really sure about what the real situation on the ground was. I think we'll get a lot more clarity on that, which should help both the government in terms of recapitalization, figuring out how much money is required, as well as for the overall investor community to get a little more comfort about the health of the banking system.
Yeah, I'll just come to Aditya Narain on that point, since he will have to evaluate the capital side of banks. But I'll just read out what you said about MSME so that everyone is clear. With regard to MSME, the restructuring framework is already in place for MSMEs that were in default but standard as on January 1st, 2020, subject to the restructuring being implemented by December 31st, 2020. The scheme has provided relief to a number of MSMEs. However, the stress in MSME has gotten accentuated due to COVID. Recognizing the need for continued support to MSMEs, meaningful restructuring, it has been decided that in respect of MSME borrowers facing stress on account of the fallout of the pandemic, lending institutions may restructure debt under the existing framework, provided the borrower's account was classified as standard with the lender as on March 1st. This restructuring shall be implemented by March 31st. So I think you're right. If you're standard on March 1st and you are in MSME, you become eligible for restructuring. Over there, even if you're SMA2 or SMA1 or SMA2, that is, you're overdue by 30 days or 60 days or 89 days, you would still be eligible for restructuring. Mr. Khara, is that right?
Yeah, I tend to agree with what you are saying. In fact, I'm going through that particular clause.
Okay. It's clause 5. Yes, sir. Sorry. Go ahead.
Yeah, that seems to be the intention here also. I mean, as it was already in place. So I think, so that they have not really made any changes as far as MSME restructuring is concerned.
Okay, so as we parse this, we have to look at the macroeconomy. We have quite forgotten that there was also a policy outside the regulatory steps. Taimur Beg is with us, the economist. Taimur, the wording seems to suggest that there is another cut, but that will come when they have made sure that when they'll be watchful on inflation, and we want to be sure that it has peaked off. I'm not quoting it exactly, but that was the undertone. Your thoughts?
Well, I admire your attempts to pivot from a very micro discussion to the macro. Well done. Look, actually, there's an intersection between your previous discussion and this discussion, which is there are two sets of challenges for the government. One is the pre-pandemic stress, and that's across financial sector and the real economy, and then stress that has been accentuated or compounded by the pandemic itself. So if you were viable before March, even if you are under a great deal of stress, I think there is a very strong room for policy measures to alleviate your stress. But if you were unviable, and there's a very large stock of loans that were unviable even before the 1st of March, that I don't think needs to be turned into a zombie type situation by constant injection of liquidity and lowering cost of finance. It seems to me that's the needle today's statement is trying to thread, macroeconomics aside. on the macroeconomic side, I think the market was wiser than the consensus. The consensus was 50-50 on the rate cut, but when you look at 1 year implied, that had come up substantially from where it was a couple of months ago, and only is about 50 or 45 basis points below the repo rate. So the market is clearly thinking that we're sort of coming toward the end of the rate cycle for the time being. If there is room to cut rates next year, it's fine. And another way of looking at it is the real interest rate. So if you take the repo rate minus the core inflation rate, whether you look at India or US or Europe, it's all the same, about minus 1.2, minus 1.3%. So we have substantially negative real interest rates in the economy. Of course, we are also going to have substantially negative GDP outturn for the time being, but already cost of funding is at a decade low, and hence on the interest rate side, there is not a whole lot more to do. And I think the markets figured that out even before we actually had the meeting today.
Okay, thanks for pointing that out. I don't know, since they said it's an accommodative stance, clearly the markets will still pencil in some rate cut or one more cut. But meanwhile, Ritu has got another bombshell of a point, and Mr. Khara, you have to listen to this. Mr. Sunil Mehta, yes, go ahead, Sir Ritu.
Well, this is just to ensure that all lenders act collectively. So to enforce collective action, specific voting thresholds will be prescribed. Those lending institutions that don't sign the intercreditor agreement within 30 days from the date of invocation will have to make provisions of 20%. So if you disagree with the consortium and if you're not able to implement the plan, then the provisioning almost doubles.
Okay, now that's big, isn't it? Mr. Khara, this will ensure that more people sign off on the restructuring plan. 20% provisioning if you don't sign the ICA, the intercreditor agreement.
So I think the intention is very clear. If at all some of the banks have got the genuine concerns for not signing the ICA, they should be prepared for shelling out even higher provision. So that is very clear. And if at all, it actually will ensure that the lenders who are not having a definite stance, they will actually be really pushed to ensure that they should have a definitive stance on the proposed resolution proposal. And if at all there are genuine reasons for which they are not inclined to come on board, they should be willing to put a higher provisioning also.
Okay. Well, I hope
in the consortium.
Okay.
Okay.
I guess a number of people may say years, maybe less, because now they've all merged into larger banks. So I think instead of 19, we now have only 10 public sector banks, and of course we have the same number of private sector banks. But perhaps the number of people who have to say yes for any loan has reduced. But if we can get that in bold red, the yes, it's up on your screen. The intercreditor agreement has to be signed by banks. If anyone stands out, they have to keep a provision of 20% on that loan. So that's a disincentive to not getting into the ICA. Faster resolution of loans. I mean, there are so many people I want to come to, but let me get to Aditya Narain on this issue. Aditya Narain, the markets are celebrating. You have a Sensex and a Nifty at 1.3% higher. This Nifty is probably racing towards its near-term high, moving towards 11,250 almost. Do you think there's a little bit of good for everyone in this? Would you dare to buy bank stocks because there is a very quick restructuring mechanism that's been put in?
No, I think there is a good for everyone. There is greater clarity in terms of the approach the RBI is going to take, both from what they've done with restructuring and also from a rate and liquidity policy. I do think, however, that, a lot has been pushed out into this committee, to the Kamath committee, to actually settle out what are going to be the ground rules in terms of these restructurings. And given the expanse of loans that are likely to, be looked at, given the rules that are fundamentally going to have to be put in place because they need to be rule-based, I don't think that's going to be that easy a task, right? So I think there will be some challenges there. I think clearly it is a step up from almost a black box that we have from the moratorium at this point in time. But I don't think it's a clear sky scenario at this point in time either, for the simple reason that this is going to be a complex process.
Completely, there is a time element involved, Aditya. Mr. Kamath will have to do it very quickly because companies will start announcing their results from October 9th or whatever, October 10th for the quarter ended September 30, and therefore you have about 60 days to frame a whole lot of rules, and banks have to get that implemented before the first results come out. So they have to work at breakneck speed. I think we have Rajkiran Rai with us. Mr. Rai, good afternoon to you. Sir, 20% provisioning if a bank doesn't sign the ICA, 10% provisioning if you do provide restructuring, and the Kamath committee to set out all the rules. Your thoughts?
Yeah, this is a good step taken by RBI to bring all lenders, so that if they are not agreeing, then 20% provision. But we need to keep in mind, like lenders are not only banks. There can be other institutions also which can be lenders to these large companies. So they may not come on the same platform. That issue will still remain. But then with fewer number banks, the resolutions will be much faster.
Okay, sir, I think Ritu has another important line that I think you cannot roll out the loan beyond 2 years. So there is a 2-year upper limit. Ananta, I guess you will all want to hear it.
Yeah.
Please, if you read that out.
The lending institutions may allow extension of the residual tenure of the loan with or without payment moratorium by a period not more than 2 years. Mr. Rajkiran Rai, this is very similar to what the CDR mechanism had also said, and that is one of the key reasons cited by the bankers for large restructuring of infrastructure loans, for instance.
I think this is a lesson learned from CDR. In CDR, the extension of loans went, much beyond. This is only 2 years. Mr. Khara, how would you read this? Maybe Ritu, you want to reread it?
This is, one of the recommendations that the committee is supposed to make, and one of the points highlighted is the lending institutions may allow extension of the residual tenure of the loan with or without payment moratorium by a period not more than 2 years. Mr. Khara.
Yeah, so I think as I read it, perhaps it would be something to do with the cash flow, and if at all there are justification for the cash flow likely to be destroyed for some more time, the moratorium can perhaps be extended. So that seems to be the intent in this kind of a clause which they have really introduced.
Does it mean that an extension can be given only up to 2 years?
Yeah, perhaps I think we'll have to go through a little more critically to understand the whole import of it.
Okay, Mr. Rai, if you your comments, does it mean that extension is only up to 2 years?
Yeah, this provision is already there actually for most of the infra projects. 2-year extension is already there. So in what context RBI is speaking, we need to see the fine print. But otherwise we can extend the repayment period without treating as NPA when there are legal issues and other clear issues for postponement. Like basically what we say, commencement of commercial operation. So that can be by 2 years.
Okay. Okay, I think this is for a restructured loan. Maybe if it is an existing COD arrangement, maybe the Reserve Bank would not have included it. Maybe there's something more to it.
This is for the new restructurings. It's very clearly set for non-personal loans. Personal loans have separate guidelines that will be issued. Only the tenor has been said that the resolution plan has to be implemented in 90 days.
Okay, well, got that. Anand, if you looked at the loans now, at the entire scheme now, does it give you a satisfaction that it's tightly controlled?
It gives me a lot of satisfaction, Lata. In fact, all the points that former Deputy Governor Vishwanathan made, I think have been adhered to. They are trying to make this principle-based. And I think this 2-year point that Ritu mentioned is probably that boundary condition that you discussed earlier, making sure that this doesn't become a complete kick the can down the road, and this is purely to take care of what is clearly a COVID-19 pandemic. Look at the principles that they've taken into account. They have recognized the need for a restructuring. It is an extreme situation. We don't have a choice. We have to do it. At the same time, learning from CDR, etc., if you make it a complete circus where it can be extended to infinity, complete, evergreening, the credibility of the system comes into question. So they've tried to make it rule-based. They've tried to make sure that everybody knows exactly under what conditions this has to be done, and they've tried to put in some safeguards of, provisioning and time-bound resolution, etc., and independent checks and balances. I think it's the best balance you could have achieved. under the given circumstances.
All right. I might just tell people who are looking at the Reserve Bank paper that this is clause number 4, page number 3 of the regulatory measures, and it has several clauses on page 4 where this 2-year extension is seen as the limit that can be given with or without moratorium. The maximum you can extend a loan appears to be 2 years. Just to read it again, the lending institutions may allow extension of the residual tenor of the loan with or without payment moratorium by a period not more than 2 years. That seems to be the limit set by the RBI. Within this, I guess the KV Kamath committee will make recommendations which may also be sectoral. Mr. Rai, is Mr. Rai with us? Okay, Mr. Rai, do you think we will get specific sectoral parameters from Mr. Kamath?
Let us wait for that. But then I think our request is not to get into sector-wise, because then there will be always some sector left out and come back and request. So it is better to keep with all these boundaries set. I think it is better we give it to everyone. Because
what he says seems to be that everyone gets it. The KV Kamath committee shall make recommendations to RBI on the required financial parameters along with sector-specific benchmark ranges for such parameters to be factored into the resolution plans. So there will be financial parameters, but looks like each sector will get a different range. Is that how we should read it?
That is possible actually, because every sector is different. See, one thing is very clear. What RBI is trying to address is only COVID impact. The corporates which are affected because of COVID are only going to get the relief. I think that is very, very clear.
Neeraj, you want to comment on this?
So, Lata, I think what they're trying to do is basically to say that when you restructure, you are going to basically look at what's happening in that sector. How much leeway are you going to give to different companies in different sectors? It cannot be one rule applied to all. Each sector has to be looked at slightly differently when it comes to what kind of restructuring can be done there. So my guess is that the expert committee will take into account what each sector is going through at this point in time and specify some kind of benchmarks for the banks to adhere to in terms of what is the sort of, let's say, lengthening of the cash flow that is likely to happen, etc.
You want it quickly, isn't it? Sorry, go ahead, Neeraj.
No, obviously, this is going to be a very detailed exercise. I don't expect it to happen, overnight. It will probably take some bit of time for all of these things to be resolved. I also feel that there will be obviously far more finer detail that will come out as we all sit down and go through these things, and probably we'll understand what more boundary conditions are going to be there on the restructuring part. So my guess is that this is, while it seems like on the face of it that this is a fairly broad brush restructuring ability that has been given to the banks, but as the sector specific benchmarks are defined, as the boundary conditions are defined, it's quite likely that the net what you could end up doing with this will be limited to those sectors which are more impacted by the COVID rather than in general, each and every borrower in the sector. Okay. So that's my guess. But like I said, that we will need to wait for a lot more finer detail on this one.
Just hold on for a minute, Neeraj. I wanted Indranil Pan also. Indranil, thank you very much for your patience. First, in terms of the cost of money, and I'll come to everyone on that, do you expect that corporate borrowers will continue to get money cheap? Or is there a feeling that we are at the end of the rate cycle? How are you reading it if you have to price the cost of money?
I think rate cycle, I don't think we are end of the rate cycle yet. And I think that the RBI is definitely accommodative in terms of its stance. They are waiting for the inflation to come down, or rather a better clarity on the inflation as supply chains work itself through. So those are the things that the RBI would be waiting for. And therefore, there can be a room for, I think, a maximum of 50 basis points at this point in time is what I can. The other point which I continue to make is that the savers are getting compromised in a very significant way because of the liquidity that is there in the system. And in such a scenario where a significant portion of the population also has to dip into their previous savings, that may be another constraint for the extent to which the RBI might be actually reducing interest rates in the current scenario. So both pulls and pressures, I think 50 basis points is the maximum that they can go down to. Anyways, the operative rate at this point in time is 65 basis points or so lower than the repo rate. Given the sustenance of liquidity, that should actually continue.
Okay. Neeraj, what is your sense? Is there a cap on rate cut? How will you all be pricing loans? Will they get any cheaper?
So I think, I think one very important aspect of this policy announcement was the extent of depth and detail that the governor has covered in terms of the impact on market pricing of rates. I think he specifically pointed out the fact that AAA borrowers today who were getting priced at a spread of about 275 basis points are now getting priced at a spread of about 50 basis points. So that's a fairly large tightening of the spreads that we have seen in the last 3 odd months. Since 27th of March, they announced the first round of TLTROs. I think we need to take into account that. So there is already a very significant amount of transmission that has happened through the bond market. Obviously, the bond market is not available to everyone. We've also seen some bit of transmission, although not of this scale that has happened in the lending market as well, but also the governor spelled out. And I think as the liquidity persists in the system, as the floor rate of the market continues to be around 3.35, and actually the market is trading below 3.35, I do expect the transmission to continue to happen. It may not happen at the same pace as it has happened in the recent past, but to some extent that bleed will continue there. As far as the rate cycle is concerned, I think the governor was very clear that there is scope, there is gap, there is space that the MPC has, but MPC is choosing to wait it out. I think they're waiting out for the inflation, a lot more clarity on the inflation and the expectations around inflation to materialize. And also I think we need to give the system some bit of a time to absorb what has already been done. We need to recognize the fact that a lot of monetary policy intervention has been put into place in the last quarter.
Yeah, actually a lot of people are waiting on phone. I'm sorry to cut you off. Mr. Rai, I know you have to leave. If you can tell me, will loans get cheaper or will deposits get cheaper first? I'm more worried about that.
Yeah, deposits have already become cheap, and this time.
But will you cut my income from deposits even more?
I don't think. Actually, we have already cut it, and as it is, there is some more possibility of MCLR cuts in the next 2 months. Even without this rate cut, MCLR, I think ultimately MCLR will reach the level of EBLR. Now, even today, there is a 50 basis point difference between EBLR and MCLR. In the next 2-3 months, most of the MCLR of the bank will tend to reach the EBLR level.
Okay, anyway, at least the EBLR that Mr. Rai is referring to, the external benchmark lending rate, at least that has not been changed at the moment. The banks have to link many of their loans to external benchmarks like the repo rate or the T-bill, and since the repo rate has not been changed, you cannot immediately expect, except when their average cost goes down. But deposit rates will not be cut. Is that your feeling also, Mr. Khara?
When I expect that I think deposit rates may not come down, because I also look at it from the point of view. If we look at the real interest rate today, so it is already into the negative zone. So from that perspective, I think deposit rates may not come down. But yes, of course, let's see how things really pan out going forward. This is also a function of what is the kind of appetite for the credit, or alternatively for investments also, because today what has happened is that the bond market has evolved well in last about 3 to 4 months time.
Yes.
And that is something which you have seen across the corporates. They are raising bonds.
Yes, sir.
So it's not merely the corporate credit which we need to see, we also need to see how the investments are panning out, particularly in the NCD market.
Yes.
Because that's the other instrument which is being leveraged significantly by the bank.
Fair point, sir. We just saw HDFC doing that yesterday or overnight. Your colleague is on the phone. Mr. Rajneesh Kumar is with us. Mr. Kumar, your first thoughts on the restructuring bit?
You had already the race and you still wanted me. Representing SBI view and representing it well.
No, of course he would, but since you are please, sir.
Yeah, so I think it ticks all the boxes in my view. The view was largely that at this point of time there may not be a change in the repo or reverse repo rate. There is enough liquidity in the market. And as Dinesh was mentioning, I just read that about the flow of credit. While we take into account, we must take into account also the investment in the corporate bonds, and Governor mentioned a figure of more than, I think, about 2.5 lakh crore corporate bonds issuance. So needs of the sectors, all the sectors, particularly financial intermediaries like NBFC, mutual funds. So this last 4 months, all the efforts have been made by the government and RBI to provide necessary support to provide the stability to the system. And today, the rates at which NBFCs can borrow, and again RBI governor mentioned that there is no issue. They are borrowing in CP market at 3.80%. So it means that the availability of funds to NBFCs is not an issue as of now, and there is no liquidity problem. About the restructuring,
yes. So just a word on the restructuring, Ritu has just read the circular, and it says that 10% of provisioning will have to be made if you restructure. Now you would have already made that 10% for the moratorium, right? So in a way, it is not an extra cost, will it be?
At least for the personal accounts.
Yeah, so I think for the way I have read it is that the additional debt, it says on the post-resolution debt, you have to keep 10% provision. So provision would have been made in respect of those accounts. Different banks, I don't know, may have adopted different policy. But the State Bank of India, we said that any accounts which were SMA as on 1st March, and there have been either no payments or one EMI paid, on those accounts we have provided 15%. But for corporate, under the existing framework, when the restructuring was done, the account classification was substandard unless there is a change of management. So one major change is that account classification will be standard even if without change of management. And second is, when account becomes substandard, then the provision requirement on the sustainable debt was 15%. Unsustainable, in any case, you were providing depending upon the fair value. So that 15%, my current reading of the circular is that instead of 15, you provide 10%.
So you're saying there won't be much of an relief? Yeah, there won't be much of an impact, at least on provisioning front, for most banks that have made prudent provisioning for these accounts under moratorium as well.
When your Q2 numbers come, will we see a higher provisioning number because of this?
Not necessarily, because one is that there is a window up to 31st December, and provisioning numbers, I think only in third quarter, we would know what is the exact provisioning requirement. So in any case, we would have made 15% provision if any account was to be restructured. To that extent, there is a 30% saving on respect of restructured account.
Which is really higher.
So but it is I think it is a very sensible move that once the account gets classified as NPA, it creates a lot of problem. Once the account is standard and the provision is 10%, it is very prudent. And once the account performs as per whatever are the conditions for upgradation otherwise also, so we have to wait for some detailed guidelines that after what period this 10% can be returned back.
Oh, okay. I guess that will have to come from RBI and not from Mr. K.V. Kamath, I would assume.
No, that will be more around the financial parameters.
Okay.
In fact,
how long do you think Mr. Kamath may take, if you were in his shoes, how long before all these can be finalized?
In any case, the time for restructuring is given up to 31st December. At least we have to invoke, and then there is a 6 months period. So we have...
You're hoping it will come in a month?
Yeah, it will come in time. Yeah, I hope so, because each sector, the financial ratios are different.
Mr. Kumar, to your question on reversal and provisions, I'll just read out because the circular is now out in the public domain. In case of personal loans resolved under this, half the provisions can be written back when the borrower pays at least 20% of the residual debt without slipping into NPA post-implementation of the plan, and the remaining half when the borrower pays another 10% of the residual debt, again while remaining standard. It is the same even for other corporate exposures, except in the case of non-ICA signatories, they have different conditions.
Yeah, I think this is similar to the June 7th requirements, isn't it, Mr. Kumar?
That's what I'm saying. So basically, there will be certain set of conditions after which you write back your provisions. But I think it is very prudent and sensible that you provide something upfront, and only if the restructuring is successful, then you write back.
You are expecting more rate cuts?
The stance of the monetary policy is accommodative. So depending upon how the situation spans out in terms of inflation and growth, it is still now next policy is 60 days away. So you can just go by the stance which is accommodative.
Okay. Any other points that we haven't covered that you want to say about the policy?
I said at the beginning that whatever anybody would demand or expect, it is there.
Okay. All right, Mr. Kumar, thank you very much indeed for joining us with your thoughts, and thank you, Mr. Khara, as well. Mr. Mehta, is there anything that you want to add?
No, I think this is what we expected, and we got it. And the second thing which I would like to clarify is there was an issue regarding the availability of this window to all the. I think Governor in his opening remarks said it very clearly that stress is felt across the board. So I think this is available to all the sectors. Kamath committee will define about the parameters for providing relief to that particular sector. So there is so it is available to all the sector. There will not be available only to some specific sector. So that point is clear from his opening remarks itself.
Okay. All right, got that. It's available to all sectors, and only the financial parameters, how much leverage and how much equity, perhaps how much time can be taken to return, those will be the things that perhaps will be decided by the Kamath committee depending on specific sectors. Mr. Rai, if you're still with us, any further thoughts on the restructuring package or on the monetary policy?
Yeah, actually there was a discussion on this 2-year window. I was just going through that. It is very clear that the remaining repayment period, residual repayment period, cannot extend beyond 2 years. So I think that boundary is also set. So it will not be unlimited restructuring. It is the restructuring which cannot extend beyond 2 years, including moratorium if you are giving. So I think that boundary is also set. I think there is enough clarity in this circular itself. Plus, see, one more thing, we need to decide by 31st December 2020 which are the accounts where we want to invoke this restructuring formula. And then we need to implement it before 30th June 21. The timelines are very, very clearly set. So I think it is a very good policy. I think Reserve Bank has touched broadly all the requests of the bank, and I think this can be implemented well.
You still think that the Reserve Bank's stress test of 14.7% at an extreme case and 12.7% as a base case NPA is a fair assessment, or given these restructuring that it may not come to pass?
That is an estimate on the extreme side actually.
Okay.
I don't think with the economy coming back to almost 70-80% level in most of the sectors, this may not be a scenario, so it will be much less than that. That is the feeling we get.
All right, Mr. Rai, thank you very much indeed for joining us and for your patience as well. Indriyal Pan, any thoughts, anything that we have left out in terms of the monetary policy? There's something on CRR deployment as well, can be done through e-Kuber or something, but I mean, I missed the details.
Yeah, so I think what they are trying to do is more a dynamic management of liquidity rather than going purely by rule-based. So that's my initial understanding on what they want to do on the CRR to prevent any even frictional stress that might actually come up at any point in time. But beyond that, I think the policy more or less has been in line with what our own thought process was. And I think he's clearly alluding to the fact that he has to see through the inflation upsides at this point and how supply chains sort of even itself out so that inflation actually comes down. So he'll be waiting for that. He'll be waiting for a suitable moment. Probably he is also waiting for some sort of a fiscal push which might, in terms of our own estimates and sort of understanding, we might see a fiscal push coming in the second part of the year, more to sort of try and push consumption up. And that could be probably a better time to provide an interest rate cut in terms of the RBI's effort also to support consumption dynamics and therefore push growth forward.
All right, it looks like it's a very comprehensive policy and all boxes ticked. Aditya Narain, anything we've left out?
Points, Lata. So first, I think one critical point which the governor mentioned, and maybe only I heard this, he actually spoke of use of OMOs for reducing the funding cost of private entities. It's the first time I've heard RBI speak of OMOs for anything other than liquidity management, and I think it's very heartening for the market as a whole.
Yeah.
Second, the fact that there was no rate cut, there was a minor sell-off in bonds, 6-7 basis points, but clearly the expectation is that OMOs will follow. While the governor was silent about OMOs and LTROs, etc., I think the expectation is they will come in when required to ensure that transmission continues into lending rates. Third part, I think rate cut is still on the cards. Clearly, we know from a statistical impact, the second half of this year will see lower inflation. At that point of time, I think Governor Das will be ready to spearhead a rate cut, provided nothing changes dramatically between now and then. Last point, whenever you interview Governor Das, I would love you to ask him why this gold loan LTV was increased to 90% at a time when gold is at all-time highs. It's something which is puzzling to me personally, and I would love to hear an answer from him directly on that.
Sure. If you ever speak to him, ask him to give us an interview. Thank you very much, Sunil Mehta, Neeraj Gambhir, Rajkiran Rai and Aditya Narain for parsing the just announced policy. The markets have given it a huge thumbs up, so we are getting a market expert yet again. Aditya Narain is still with us. Aditya, does this make, in the first place, since Anand spoke about gold loan companies and the higher LTV granted, even at these pricey levels, do the gold loan companies become attractive?
See, I think two things. Firstly, in terms of the measure, I think that's a positive measure in that it actually reinforces the fact that that's a form of getting liquidity, right? The fact that it's gone up to 90% might be a little aggressive, but I think it just directs a large part of the populace towards taking liquidity from here. In terms of the stocks, I think because they've run so much, and now you're probably having more of a run, I wouldn't, keep chasing them at these levels. I'd probably just wait a little bit, simply because of the scale of the run up that these stocks have had in any case.
Okay.
But by and large, I think the approach to provide high quality collateral in the system for retail and for some businesses possibly, I think that's generally a good approach. Yeah.
Isn't the entire policy very positive for stocks, I mean listed and unlisted? The fact that the restructuring has been given and not made to lose. Everyone gets a 2-year window to repay. I mean, repayments can be lengthened up to 2 years. Other details, of course, will follow from the Kamath committee. That itself is a sigh of relief, isn't it?
So I put it in two ways. I think what the policy spells out, right, is what this restructuring is not. Right? That's how it defines the boundaries, and it's basically learned from its previous experience,
yes.
right? So I think that's good. So the downside risks typically that played out the last time, they seem to be protected against. So I think that's I think the devil lies in the detail, and it's going to be very difficult detailing this. And I think that's where there might be, some easing in terms of very buoyant sentiment that has come through at this point. Across the board, some of the panelists basically mentioned whether sectors should be introduced, whether XYZ should be introduced or excluded. You put that in combination, there's a huge set of combinations that can come through. And I think that will blanket one. Right? Yeah. But over the course of the next 6 months, whether it is disclosures, whether it's opt-ins, opt-outs, there are lots of nuances that can be, hard to effectively manage.
Yeah,
right?
That's right.
So I think that will take time, and I think one shouldn't underestimate the challenges there, firstly.
Yes.
And my view, quite honestly, the simpler it is, the more effective it will be.
Okay, well,
If it is to be very detailed in sectors and sizes and all that kind of stuff,
Yeah.
I think it will make it more complicated.
Yeah, it's not being written by a bureaucrat, it's going to get decided by Mr. Kamath. So I would assume that he would know what a banker is looking at or what the market is looking at. And I'm assuming therefore that it will not be lost in the details
I
or
would
made
hope so. The way I would put it is, it should be rule based and it should be very limited rules.
Okay. Yeah, we'll have to wait for that. I guess it'll take at least a couple of weeks or if not a month to do this exercise, but we'll wait and see what comes from it. Thank you very much, Aditya Narain, for joining us. And now we have perhaps the best voice when it comes to assessing the economy and policy. Pranab Sen, the former chairman of the Statistics Commission and the chairman of CNBC TV18 Citizens Monetary Policy Committee with us. Dr. Sen, you would have had enough time to look at all the headlines and the key takeaways. Your first thoughts.
I think RBI has done about as much as it could. We I think laid too much expectations on RBI, particularly given a situation where nothing else seems to be happening. It's RBI which is being proactive. But having said that, I think pretty much everything that was announced was along expected lines, and the restructuring rather than the extension of moratorium, I think is a very desirable step. The restructuring will actually, I think, restore a certain degree of confidence in the banking system. But having said all that, I think, the point that Anand was making is valid, which is that the rules of the game should be kept very simple. I mean, this is not a stage at which I think anybody can and should try to predict the effect of the lockdown and the subsequent sequence of lockdowns as the disease incidence varies from place to place. This is not the time when one goes into very sectoral details or put sectoral caps on decisions that banks are taking. I'm glad that they are reconsidering this, and this really should happen. The only thing that I still worry about is that there is and has been for a while now a certain degree of loss of confidence in the banking sector by the depositors.
Oh.
This is something that really hasn't been addressed. Perhaps it can't be addressed, but one would have really liked to have heard something to the effect that, we have been in discussions with government and the government is preparing a blueprint for propping up the banking sector when required. I mean, recapitalization is almost certainly on the cards, but it is better you say it now than hold it off till a time when the confidence of depositors is completely lost in the banking sector, because then it will be too late.
You
so
said that. Said that in the Monetary Policy Committee deliberations that we had, that recapitalization needs to be.
And it's getting worrying now, because if you look at what's happening to the stock market, there's a huge bump up of retail investors. Institutional investors are doing practically nothing. It's almost entirely being driven by retail investors. Now, there is already so much froth in the stock market. Maybe herd behavior is working, but the fact is, I think it's been driven much more by not just the low returns in banking, but far more than that is the uncertainty about the banking sector as a whole. And this really needs to be addressed.
All right. Well, that of course falls in the lap of the sovereign, and one hopes that will be done sooner rather than later. Dr. Sen, it's always a pleasure having you with us and giving us the last word on the policy. Thank you so much for joining us. Well, that's the policy. It's out, and as most of our experts have pointed out, it has checked all the boxes. A rate cut was not expected, and Dr. Sen himself had voted against. He had voted for a pause. That was our Citizens Monetary Policy Committee's majority view, that a cut will not come, but the stance will be accommodative and something will come later on after inflation peaks off. But that's on the policy. And on restructuring, it looks like almost everything that could be done to restructure loans without making it a no-holds-barred restructuring as was in existence seems to have been delivered by the Reserve Bank. A veteran commercial banker from the private sector will be setting in the ranges for the financial parameters for each sector, maybe sectoral or maybe for entire industry. It looks like it's exactly what the doctor ordered, and we'll see how the markets react henceforth. At the moment, the bond markets shrugged off the minor disappointment. There was about a 4-5 basis points reaction. That was it, to the lack of a rate cut, and the stock markets are soaring. Thank you very much for joining us in this monetary policy special. We have more lined up for you.